The drop in Bitcoin, we think, was more, well, first of all, it was more severe than we expected. And I do believe it's because of the liquidity constraints and restraints that we have seen during the last couple of months. We always believed those would be short term, and still believe they will be. And so if we are right, we believe that the Bitcoin to gold ratio will resume its uptrend.
Cathie Wood opens with a big picture view of today's markets, noting that investors across equities, gold, and crypto are facing growing uncertainty. Liquidity conditions are shifting after the massive COVID-era money expansion, and gold's surge relative to money supply is flashing levels seen only during the Great Depression, raising concerns about the dollar's long-term value. She points to two key forces driving markets. First, money supply growth is flattening and velocity is slowing, signaling disinflation rather than sustained inflation despite widespread fears. History shows gold can fall sharply once confidence returns to productive assets, as seen after 1980 and 2011. Second, the deeply inverted yield curve continues to warn of economic weakness, even as risk markets appear unusually calm. Before we continue, please like the video, subscribe, and turn on notifications. Explore our other content on macro trends, innovation, and digital assets, and share your thoughts in the comments. Your support helps the channel grow.
It is striking that gold relative to M2, and remember we're saying M2 is starting to flatten out here. Gold relative to M2 really is as high as it's ever been, except for the Great Depression, when the money supply was collapsing, negative. It's no longer that now. And back then, gold was revalued. Or I should say devalued. It was a devaluation of the dollar in terms of gold. And that's why the spike back then. Now we don't have the first condition anymore. Money growth has turned positive. But we do have the second condition in terms of the dollar losing value relative to gold. And I think one of the bets that investors in gold are making is that the liquidity that spewed out during the COVID crisis is still going to find its way into inflation. We don't think so if money supply is topping out and velocity is rolling over. Now, I would like to give you, now that everybody thinks gold has only one way to go, if you look at the last two spikes there, meaning the last two other than the Depression, so the one in 1980 and the one a minor one in 2011. In 1980, gold peaked at $850. I was very young in my career, and I remember the day. And over the next 4 to 5 years roughly, it dropped 67%. Why was that? It was because Reaganomics was working, and investors decided to focus on the equity market and the bond market instead of hedging, continuing to hedge against the inflation that had been debilitating during the 70s. Inflation came down and continued falling, and the dollar became very strong. The dollar became better than gold. It was appreciating as gold was going down. And so gold dropped about 67% to $284 in February of 85. So yes, the gold price can go down, and we think we are moving into more than a Reaganomics market. We think this is Reaganomics on steroids, based on, especially on the tax cuts and the deregulation. Those two are much more formidable right now than they were in the early 80s, with the exception of the individual tax rate back then did drop by quite a lot, by 25%, I think, but it was phased in, and that's not the way to go. One thing about this administration, it has learned its lessons from the mistakes of Reaganomics. Do not phase in a tax cut. They made it retroactive. That was very smart. In 2011, the gold price peaked in September at roughly 1900. And by December of 2015, again, roughly 4 years later, we talk about the 4-year cycle in Bitcoin. That's pretty interesting. Both of those were effectively 4 years. Gold dropped from 1900 to 1050. So that was a 45% drop. And we would not be surprised to see something like that happen during the next 4 to 5 years. So on the next chart, just want to give you a sense of or a picture of liquidity. So liquidity moving down, what we told you during the last In the Know was that the combination of the end of quantitative tightening, now that was only on December 1st, so it's hardly had any time to impact, but that is effectively adding liquidity to the system relative to what otherwise would have been the case, to the tune of $30 to $35 billion per month. So that is going to help turn this line up. And then the Treasury General Account, we think, is going to go up. Now, the Treasury General Account cash built to the tune of $350 billion during the government shutdown. It has not, even though the government shutdown has ended, it has not started to unwind that liquidity, but we believe that it will, and actually is in the process of doing so. So we think this line is going to turn around fairly dramatically. Now, just to reinforce what I said before, those betting on gold are looking at what happened to liquidity during COVID, and it doubled. It doubled. These are very big numbers. Doubled from 3.5 trillion to 7 trillion. And now we're back down to 5.5. There is a fear that doubling will reverberate in the form of inflation. We think in the next, as tariffs work through the system, that the surprise is going to be on the low side of expectations, and that those worried about inflation will have to think twice about how they're positioned in the marketplace. Here it depicts the yield curve. It's at the short end of the curve, the 2-year minus the 3-month Treasury bill yield. And you can see this is still inverted, still below zero. And you can see anytime that has happened in the past, certainly for any length of time, we've seen a recession follow. And it has been amazing that we have not been in recession, but as we have mentioned before, we've been in a rolling recession. As the Fed eases, and we do think the odds are 80-90% for a cut on December 10th, this should start moving above zero. And then the longer term yield curve, which I know I talk about all the time, I'm kind of obsessed with it, is I think telling a story. We've put a downtrend here, a trend line, since 2008, 2009. And we were surprised during COVID that the yield curve did not reach levels it had reached before, when the Fed was fighting recession. It reached roughly half that level. And here we are. Could we be peaking now? Well, that would be very interesting if short rates came down, if short rates and long rates come down, but this yield curve does not steepen anymore. I think it will be telegraphing that there are deflationary undercurrents out there, and hopefully some of the bond strategists will start analyzing it from that point of view as well. Here's just real GDP and productivity. I present this marveling in part that real GDP, the purple line there, the growth rate, has hovered around the 2.5% range in a rolling recession. Of course, government spending and high net worth consumer as stock prices and to some extent bond prices moved up, and housing prices also, existing home prices. So the wealthy have done very well, but the rest of the economy, small business, low, middle income consumers, it is time for them to be able to join this kind of growth rate. And we think that that will happen during the next year. Productivity, roughly a little around 2% in a rolling recession. That's pretty good. If you look back in history, it's stronger than where it's been or where it was during most of the post-global financial crisis period. And we think it's going to continue to move up, as I've mentioned in the past, and perhaps be sustained in the 4 to 5% range, which would be a real breakthrough, being sustained. We got there at the end of the tech and telecom bubble in the late 90s, but it wasn't sustained. I mean, we went through recessions and a pretty bumpy road there. Market and price indicators, S&P to gold. Again, watching that 70s period where it was a waterfall. There are some people betting that inflation is going to be that problem again. We are not. But this isn't a holding pattern, and we think it will test, and the next move will be up, test well, and the next move will be up. But we are monitoring it closely. Here is, we think, a leading indicator. You see this S&P price to oil price plummeted during the inflationary 70s. It's doing the opposite now. So this, we think, is a leading indicator to the S&P to gold ratio. And here you can see long-term interest rates over the last number of decades. The peak, the double-digit peak in 1981, and the trough during COVID. And so the question about today's rates is, are we simply back into a period of normalization? Just the market working and 5%, 4 to 5% being roughly the GDP growth rate, and interest rates following. I don't know. We will have to wait. My guess is we will see a leg down toward that 2.5-3% range, and that will be closer to the new range for the next few years. Spreads, the spread between high yield rates and the 10-year Treasury rate, a measure of credit risk building in the system. The market's not seeing it. Again, I say it's hard to believe. We hear first plans going bust, and we hear some turmoil in the private credit market, and yet you don't see it here. Maybe there's just too much money reaching for yield, and that's where the bubble is today, not in AI. Many people think AI is where the bubble and the risks are. These are credit default swaps for Oracle and even Apple. And you can see what's happening here. These are insurance policies against defaults. And when they go up in price, it means there are investors. And we think the banks could be laying off risk here, who think that maybe the spending spree in data centers is just too much. So we don't think so. We like this wall of worry. We like the concern, scar tissue from tech and telecom bubble. It's all a good thing. And I'll end, as usual, Bitcoin to gold. This has the drop in Bitcoin, we think, was more, well, first of all, it was more severe than we expected. And I do believe it's because of the liquidity constraints and restraints that we have seen during the last couple of months. We always believed those would be short term and still believe they will be. And so if we are right, we believe that the Bitcoin to gold ratio will resume its uptrend.
A key takeaway from Cathie Wood's analysis is that current market signals are being misread. While many investors see gold's strength as confirmation that inflation is returning, Cathie argues liquidity trends and money supply data point instead toward disinflation. She reviews common narratives, persistent inflation, an AI bubble, and a lasting loss of confidence in fiat, and finds they don't align with indicators like M2 growth, money velocity, and the yield curve. History shows gold can fall sharply once liquidity normalizes and confidence returns to growth assets. Despite recent volatility, Cathie remains constructive. Improving productivity, easing financial conditions, and long-term innovation continue to support risk assets, with Bitcoin likely to regain strength relative to gold over time. If you're enjoying the analysis, don't forget to like the video, subscribe, and hit the notification bell so you never miss future updates.